Special now, will the RBI's new guidelines on debt restructuring trigger deals in stressed assets for their revival? And what are the limitations of the S4A norms, the latest set of norms that have been put out by the central bank? Well, find out from the ones in the thick of the action. Here's an excerpt from our special show, The Big Deal.
One of the key concerns of capital providers in the stressed asset space was who will manage. And there was an acknowledgement of the fact that a lot of these stressed assets arose not because of poor management, but because of extraneous situations, sort of industry cycles, regulatory changes, court decisions, etc. But the management was fundamentally competent and sound. So there may be a scope for continuing them, but just restructuring the balance sheet and making it work. So there are a large number of such situations. Equally, from the providers of such capital, whether it's stressed assets funds or private equity or otherwise, you must realize that one of the biggest problems that they face is a lack of being able to find a third-party manager for this. No, they are not managers of assets, they are providers of capital. So this interestingly fills in that gap of having a manager on a case-by-case basis and still doing the restructuring without necessarily throwing the promoter out.
The larger issues that have especially come up for the lenders are a lot from the steel sector, as we have seen. Some of the companies, and I can't name them, 45,000 crore rupees of debt from one company itself. Now, in such a scenario, do you think that S4A is going to really give them any relief? Are you looking at that?
See, again, S4A, it has two components. One is about that sustainable component, which is part A, we say, and another is the unsustainable component. Now, if the sustainable component is good enough, and if there is a value for the equity, still the investors can come, because the valuation of the equity is slightly different than the whatever total debts are there on the company. So, equity valuation, if it is done properly, and if the new investor sees there is a value or there is an upside for whatever value is present value and the future value, I'm sure there will be a lot of interest generated from the investors.
All put together, of course, it is going to be a long drawn process, a complex restructuring that we are going to see. But purely from the fund's perspective, Mr. Piramal, what is the kind of returns that you are looking at, and what could be the timeline for these redemptions, at least from your funds? 3 to 5 years, is that one of the timelines that you're looking at all?
So the fund will have to be a longer duration fund. I look at it a fund of, because it's going to be a restructuring of companies, it could be anywhere from 5 to actually 10-year fund. I don't expect that a turnaround will take place in 3 to 5 years. It'll be longer than that. The returns, these have to be returns in excess of 25%, because otherwise it doesn't make sense to take so much of risk and to put in so much of effort.